Good afternoon and welcome to the June buy-to-let mortgage market update. My name is Richard Purnell. I'm from the Mortgage Home and we are your buy-to-let mortgage experts. As always, I like to start off by looking at interest rates. And I've got plenty to talk about this month, as you might imagine, could fill the whole presentation on this. So where do we start? Now, the first thing I've got to say is at the time of recording this, it is Monday, the 19th of June. By the time you're watching this, I suspect it will be after Thursday, the 22nd of June, which is when the Bank of England next meet. And I suspect rates will have gone up. So let's take a bit of a dive into this. So right now we're at 4.5%. There's been 12 rises, consecutive rises in interest rates by the Bank of England in recent years to bring us to this point. I suspect it's going to be at 4.75% next. No real surprises that there's another raise. I've been suggesting all year that there will be more rises to come, and possibly in June or July. But given what's happened with inflation rates, that's the main reason why the Bank of England are actually putting rates up maybe a little sooner than some people might have predicted. So I expect them to have gone up to by 0.25%. But given what the Bank of England have come out and said in the last few weeks, essentially inflation is being stubborn. They're not allowed to swear, so that's the phrase they tend to use. And then the inflation isn't dropping at the pace that they said it would drop back in the early part of the year. And that's what's caused the big ripple effect. Now, you might say, well, what on earth has inflation got to do with the Bank of England and interest rates? Haven't really time to go into the detail. One, I'm not an economist, but two, it can take quite a bit of a time to explain. So other than it's part of their remit to try and get inflation down, and they use interest rates as some sort of real blunt instrument to do that. That's all you need to know for today. And so they're going to put interest rates up, I suspect, to try and have that impact of ultimately bringing inflation down. So given that inflation is dropping at a slower pace, therefore, I would certainly read into that I would expect further Bank of England rate increases in the year. Now, hold on, before we all get too upset and thinking that's going to translate to mortgage rates, my personal view is it will not. It will not translate into mortgage rate increases further down the line, and I'll explain that shortly. But I do expect the Bank of England rate to go up. If it's at 4.75 when you're watching this, I would expect it to go up at least another 2 times this year, as far as we know. If the Bank of England have to come out again and say that inflation is dropping at an even slower pace than they've currently come out and said, then that's when I'd expect even more interest rates from the Bank of England. But if they do not, if the pace drops, it's at 8.7% right now. They were saying it was going to get down to 3% by the end of the year, and I think they revised that to maybe 5%. Forgive me, I'm not totally sure on the numbers, but you get the idea that it's a slower pace. So it's that revision by the Bank of England that not only means that the Bank of England are going to put rates up, but as what has initially caused mortgage rates to increase on this one occasion. So long as I say, the Bank of England don't revise their forecast on inflation again, then I would anticipate that the financial markets, these are the people who are ultimately fund the non-bank lenders. And I would think that most people watching this video, when they're getting mortgages, are not going to the high street banks, because high street banks, as we know, don't like portfolio landlords. So it's the secondary lenders that have to go to the financial markets in the first place to obtain wholesale money. And it's how that wholesale money is priced, which is based ultimately on or partly due to how inflation is dropping. So because that revision by the Bank of England means it's dropping slower, has had a knock-on effect on the wholesale cost of money. which then feeds through to what we see when we're getting buy-to-let mortgages. So that's the circle. So as long as that forecast on inflation doesn't change, even though the Bank of England may still be putting interest rates up again, the financial markets know that, they're expecting that, and they're building their prices in knowing what the inflation is going to drop at based on the Bank of England predictions in the last week or two. So as long as that does not change, I do not expect further mortgage rate hikes. However, clearly over this last month, a lot of volatility, and why we saw the initial rise over this last month, and are still seeing it right now. Sadly, because for reasons that I don't understand, because we're getting into the nuances now of pricing of wholesale money, which is clearly out of my skill set, it's taking the financial markets a little while to price up their what are called swap rates, which work through into the wholesale cost of borrowing, which then feeds through into the secondary lenders' retail pricing. It seems to be taking a little while because it's been quite a few weeks now where lenders have been pulling deals and replacing them with higher rates. And as I say, that volatility, that uncertainty is, I'm still seeing, has been going on up to last Friday. I do expect that to settle down literally in the next week or so. That should start to settle. So the rates that we're now seeing with on mortgages should start to settle. So in terms of your decision making, whether to buy properties, whether to refinance, the sort of rates that your brokers will be coming out with now, today, this week, I don't expect to change much more from where we're at now. Maybe minor tweaks, literally 0.1 perhaps, but no major changes in rates is my view. And that's the message I want to get off. What I would also want to point out, that bottom next to last bullet point, please be patient, be kind to your broker. We are the middlemen in this process. And unfortunately, lenders are giving very little notice when they've been pulling their deals, which makes it really frustrating for you as the customer, but also for us as the broker when we've been talking about interest rates, and then when it comes to it, the rates have gone up slightly. And like I said, because the deals have been pulled with no notice. So the last takeaway point I want to make on this slide is, if you are looking to buy this year, in the near future, is get your ducks lined up, get everything in order. Look at your 22, 23 self-assessment returns. I know I can hear you saying they don't need to be done until September. You don't need to even do it till January 2024 from a tax point of view. However, if you're wanting a mortgage, we need it now. We need them today. So talk to your accountant. Get them to put it at the top of the queue so that you can get your tax returns done sooner, and then you'll be able to get your mortgage application in. So this is what I mean about getting your ducks lined up. If you've not done those 22, 23 returns, then you should be on with it so that you've got them in hand. You don't have to pay the tax bill. You can have your returns done now and pay your tax in January. It's the documentation we need as the brokers. Other things like, have you checked your credit report for a little while? If not, get a copy of it. Have a look through it. Is there any skeletons in the cupboard? Is there any late payments on there that you didn't know about? Is anything that we don't want surprises? Anything that might be a little bit of a shock? Check it out. You can get them for free. So do that. Your bank statements. What about those? Have you got the right address? Have you moved address recently and never changed the address on the bank statement? People don't do it nowadays because everything's online, but from a mortgage point of view, it has to reflect the current address. So things like that, speak to your broker, see what he or she wants, get that shopping list of documentation from them, and lodge it with your broker so that when he or she does show you that rate, you can say, yes, get on with it, and we can get that application in same day, maybe in 24 hours. In this section, I want to talk about holiday lets, in particular the larger holiday lets, in context of their planning usage. Now, holiday lets need to be on, in England, could be on C3, but certainly if they're a larger holiday let with more likely be talking about a sui generis classification. In Wales, they've brought in some new classifications, so be mindful of this, C6 in Wales. In Scotland, again, they've got their own usages. That will be C9. Now, I'm really going to focus in on England for most of these slides. However, in Scotland, there's been quite a few changes. Obviously, last October, they brought in licensing, and watch out, watch this space. It's going to come in England. I think it's only a matter of time. The government have no idea how many holiday lets are out there. They don't know the numbers. They don't know the impact on local areas. So it is going to get licensed. I'm sure of it. In the meantime, Scotland are ahead of the curve. They've already done that last October. So if you are buying in Scotland, you will need to get a license for that property. Now, in addition to that, this is totally independent. There's also a growing number of PCAs. These are planning control areas. Now, as far as I can tell right now, there's only a handful out there. Edinburgh, Speyside are just a couple of them. And these, like I say, they're independent of the licenses. So these give local authorities the control over whether they want a holiday let in that particular area. So essentially, it's a planning application you would need to submit to the PCA to have planning approval for a short-term let, in addition to a license. So you've got two things that you need to sort out if you are now buying in Scotland, and if you happen to be in that particular area where a PCA application is required. In England, if you have 7 beds or more, then lenders are saying that there's a differentiation in terms of the type of classification you want. And generally speaking, lenders will want that to be on a sui generis classification. Now, if you actually look at the planning classification itself, it doesn't talk about beds at all. It talks about the occupants of a property. And so once you go over 6 occupants that are not related, then that's the cutoff to go to sui generis. So that's where lenders, I think, have taken that interpretation to convert that to bedroom. It's a little easier for them to check out from a property perspective. So that's the tipping point. And so if you're buying a holiday let that is 6 beds or less, not only is that a C3 classification, which is what the classification will be on anyway, because that's also domestic dwelling classification. So nice and easy for you guys buying the smaller properties. And that's also where the appetite for lending is. There is more lenders on that side of the line. But we have a significant number of lenders that still have appetite to lend when it's 7 bedrooms or above. But we will need to think about the change of use to sui generis. In addition to that, I know a number of people that are watching this will have on their radar looking at properties that were more commercial, let's say. And I've given some examples on this last bullet point: bed and breakfast, guest house, care homes, to name a few. They will be on a C1 or a C2 classification right now. So again, you will absolutely have to move that across to probably a sui gen classification at some point through the process. So these are the things that, as a landlord, if you're buying these larger holiday lets, you've got to understand: where are we right now? Where do we need to move to? And from a lender point of view, what is their expectation? So to summarize, think about the timescales that are likely to be involved in that change of use. How long is that local authority where the property is taking to get change of use put through? It could be 2 months, could be 3 months. What if, particularly if you're talking about B&Bs or care homes, there's likely to be conversion costs? So what's involved in that? Do you have a schedule of works? How's that going to be financed? What's the lender's view on that? Generally, if it's just cosmetic work, they'll turn a blind eye or won't be bothered about it. But if it's more significant, then the lenders may not want to lend on that property until that work's done. And if you're buying it, that means you've got to think of an alternative way of acquiring that property. Same with change of use. Don't assume that the lender will allow you to get the change of use in place on completion. It might be, and this is where, again, speaking to your broker is absolutely crucial, that the lender that is absolutely right for you and your situation and your circumstances with the right rates and for that particular property might be fantastic. However, they may be insistent on saying that that change of use has to be in pre-application. So again, how are you going to secure that property if you've got to move it from C1 to sui generis before you even submit an application to buy the thing? So this is where my last point of 3 possibilities that you can consider in that regard. Great. Have you got the cash to put 3, 4, 500,000 pounds in to buy it? You know, fantastic if you can. Are you already considering joint ventures? Do these guys have the funds to put in all the cash to allow you to buy it? If not, well, bridging is the obvious alternative that will allow you to secure that property, buy you the time then to get the change of use in place. You're also doing the conversion if that's required, and then you're presenting that property with the right classification, with the work done. Bang, there you go, to the lender, and hopefully they will approve it as a refinance to pay the bridging off at that point. So these are things that you guys will need to think about, in particular when you're buying these larger properties. Now, if you want to have a further discussion about anything that we've talked about, there will be a link to our online diary for the company, and you can jump on there, book an appointment, and have a chat about maybe some specific circumstances. Maybe you've seen a property and it might have planning changes that are required. Maybe it is a bed and breakfast right now, and so talk to us at the earliest opportunity so we understand whether it is a 1-step or a 2-step approach to get the finance in place so that you can get that holiday let up and running and enjoy the profits that will no doubt follow. In this piece, I want to talk about you portfolio landlords that are really struggling financially now to make a living out of property. We have, of course, as a backdrop, Section 24. It's hit home now over those last 4 years. It's fully implemented. It means that obviously our expenses that we can include have reduced when it comes to mortgage interest, and of course that impacts on our profitability. We've got potentially the EPC changes coming in the not too distant future. We've got the threat of Section 21, no fault eviction notices being removed. So we've got all this about. We feel like we're being clobbered from every angle. And then, of course, since October of last year, we've had the significant spike in mortgage rate increases. And for me, that is it's not the straw that's brought the camel's back. It's on its own is a significant factor to why landlords are getting disillusioned, in particular for those that have got family-let properties, because everything I've mentioned there has an impact if you have family-lets. So when your typical family-let generates, let's say, £200 to £300 a month of profit, assuming you've got a mortgage on there that are geared up to 75%, then you know, generally speaking, I would expect that you're putting, like I say, £200 to £300 a month in your pocket up to September 22, when all of a sudden mortgage rates doubled in a couple of weeks. And that doubling of a mortgage rate, when you've got an interest-only mortgage, very easily swallows up that £200 to £300 a month profit. So all of a sudden, your profit has disappeared. And if that is your only source of income, then it's understandable that you are in a corner. You're in a desperate situation. What do I do with my portfolio? And they feel that you need to sell. And I was noticing on a report I read in the last week or so that CGT, capital gains tax, has doubled for the government in the last 5 years. It has doubled. And absolutely, one of the main causes of that is landlords feeling forced to. They didn't want to sell. That was never their exit strategy. It was supposed to be a pension for life, but they cannot wait. They cannot afford to wait for rents to increase and balance the books again. And therefore, they feel that there's no alternative but to sell. And so this piece is about, as the headline says on here, repurpose your portfolio, never sell. And I just want to sow some seeds about some alternatives before you end up not only selling, but giving away yet more tax in CGT to the coffers of the Treasury. So, oh, and by the way, sorry, one last thing before I get onto these things. Capital gains tax, not only are they raking those receipts in right now, but the government have even tied the knot more and reduced the allowance that we, if I can say, we're enjoying. If you own that property in personal names, every individual that owned it, if you owned it in joint names, you 2 times that allowance would be about 12,300 a year. That's now halved. So they talk about kicking you when you're down. So that allowance is 6,000, and next year it's due to drop yet again. It's got pretty much it's going to be non-existent. So what are the alternatives, Richard? You're asking. Okay. Well, here's the thing. I know many of our landlords have absolutely been analysing their portfolios to see whether short-term letting is appropriate for their property. Now, that short-term letting heading consists of 2 parts. You've got the obvious holiday lets. Now yours might be shouting at the screen. Yeah, but my property is in an area that isn't really attractive for tourists. Bear with me. Let's assume it might be in a tourist area. Let's, I don't know, York, Manchester, just a couple of examples. But you say, well, yeah, but will people want to go to Manchester for 2 weeks? Well, maybe not, but I can absolutely tell you that there's a trend, a national trend now for holiday lets to be booked more for weekends than 1 to 2 weeks. So those mini breaks, the city breaks, are getting more popular all the time. Now you might be saying, well, yeah, but 2 days worth of income isn't really going to cut it. But it's not how it works with holiday lets. You'll earn 90% of your weekly revenue by pricing your weekends accordingly. They're weighted to the weekend. So you don't care in a way that Monday to Thursday's vacant because you get most of your income over the weekend. So don't worry about that. So holiday lets, is it in a country? It doesn't have to have that view over the sea. It could be countryside, rural type location. So have a think about that. Investigate it. Speak to some of the national specialist letting agents. One example, Sykes. Might not thank me for mentioning him in case they're inundated, but give them a ring. They'll give you free projections. This initially desktop, so really quickly within a few days, and they'll give you an analysis, a projection of what sort of income you might expect on your short-term let. If then that looks like it's in the right ballpark, you can get them to come out and do an actual survey of that property. No cost. They want your business. So that's holiday lets. The other one, I said there was 2, is serviced accommodation. Now, my definition of service accommodation, again, short-term lets, but it's for workers. So again, if you've got a property that is in a more industrial area, commercial area, it's more in the city centre, and again, not a touristy type town. Yeah, well, is there industry there? Is there lots of business there? Are there people coming in, contractors, workers, tradespeople, consultants, hospitals? Could there be demand for that property for that type of guest? Again, speak to these national letting agencies. They'll tell you if there's the demand, how much that is, and then do the maths, work out what the expenses are, see what you're going to retain, and see if it is worth repurposing that property rather than selling it. And it might be then this is a 1 to 2 year thing, and it might be that once the family let rents get back to it, which I think is 1 to 2 years before the rents come back on par, you've got a choice. Do I stick with short term or do I move back to family lets? And by the way, look at my last point on here. There's tax incentives. When you move your property from family let to short-term let, all of a sudden you open doors in terms of the tax benefits that are on offer that are closed off to you while you're a landlord with family let. So you might want to write this down. Capital allowances, look into it, investigate it, get some advice on it. We're not tax advisors, but speak to us. We've got information on it so you can see whether there are additional savings that you can make on your taxable income so that you retain more of the money that you're making. This is what it's about, guys. So, those additional sort of benefits there. The last thing I want to say, and this is the next to last bullet point I've got in here. If you're fatigued, and I get it from that first point I said at the top, we've been hammered as landlords for the last 4 or 5 years by the government. And you might not have that fire in your belly to say, do I really want to learn about short-term letting and move things across and manage the property on a new. I don't want to learn this new sort of method. Find a landlord that does. I can absolutely assure you that there are landlords out there that are keen to talk to landlords like you if you're saying, I haven't got the energy to do it, but I get that I don't really want to sell if there's an alternative. So if you can be connected with a landlord that has the energy to use it on a short-term let, then come to an understanding. Come to an agreement with that landlord who will take over the running of that property in a legal framework. They'll manage it on a short-term let. They'll take some of the extra profit, but they'll agree to give you a guaranteed income over and above what you're getting now, so that not only are you paying the mortgage, but you are now making a profit yourself. Is that not a win-win? Now, if you're saying, where on earth do these people hang out? Then again, contact the office or drop us a line and I'll try and connect. So I do know there's landlords out there that are really open to these conversations. And if you're at the other side of the fence, then if I can help and put you guys together, then, that's a win-win all round. So there will be a link to the diary. You could maybe book an appointment just to chat that one through, or give the office a ring, 01756 699 600, and we will maybe take your details and then try and connect you with one or two landlords that could help in this regard. Your last resort is selling. Property is the right thing. It's still going up in capital growth. The rents will equalize, but right now I get it that people maybe think they have no option to sell. In this piece, I want to talk about life insurance. It is a staple of our company's offering. We are mortgage specialists. We're also specialists within life insurance, critical illness, and the what's called the protection arena. So I want to talk a little bit about the regular issues and pointers that we want to give to our existing clients when we're reviewing existing policies, because this just might resonate with you. So these are common things that we find. The first thing is, when we're reviewing existing life cover, is that we find that the term remaining on your life policy does not match that of your mortgage. It would have done when you originally took it out. Maybe you took out a 25-year mortgage, so you take out a 25-year life insurance policy. The two go in sync. When the mortgage is paid off, there's no need for the life insurance policy. Nice and easy. However, life gets in the way. You move house. You get a different mortgage. You get a different term. Or you borrow more, and so you extend the term. And so the last thing that you want is to find out that these are a mismatch when you need to claim on your insurance and to find the insurance has actually ended, but your mortgage is still there. So dust that policy off now. Check how long's left on that life insurance policy. See if it matches your mortgage term. And if it doesn't, get in touch with us. Sadly, it's not as easy as just ringing your existing life insurance company and saying, will you extend my term? That's not something they do. You have to start again. And if you're starting again, it's best to start off now, not in 5 or 10 years' time when that comes to the surface, because you're 10 years older, and guess what? Life insurance policies are more expensive. So have a look at it now, dust it off, and check the terms that are remaining. The other thing that we notice on a really regular basis, because getting life insurance to repay your residential mortgage is the first rung on the ladder. So here's the point I want to make. You may have life insurance to pay your mortgage off, but what if the person that got squished under the bus was the major wage earner? And even though the mortgage is paid off, you've also lost the main income coming into the house, which is substantially more than the mortgage payment. So from a cash flow point of view, you're actually worse off. I'll say that again, from a cash flow perspective, even though the life insurance has paid the mortgage off and saved you £500, £600, £700, £800 a month, whatever it is, you've lost the income of your spouse or partner. How much was that? 30 grand a year, 40 grand a year. So you're actually worse off. And it could easily be that you cannot afford to still stay there. So you still have to sell the marital home or the family home, that home that your kids live in, which was the whole reason you got the initial policy. So what am I saying? You may need two policies, one to pay off the mortgage and another one that pays a lump sum into the family coffers so that the person remaining can stay in the house, pay the bills, keep the roof over their head. It's so often people don't think of that second policy or do the maths to see, well, what would happen to us? Are we at risk? If the answer is no, okay, you don't need it. Do the maths and then take a view. You can tell I'm passionate on this. And the last thing that we do come across from time to time, clearly there has been a trend for a lot of years now for people to quit smoking. But we also see that when the original life policy was taken out 10, 15 years ago, you were smokers. Typically, this, I'm really generalizing here, if you were taking out a life policy today, one quote as a non-smoker, the next quote as a smoker, the smoker policy will be 50% more in premium than the non-smoker. That's how much they weight the premium when you become a smoker. The reverse is true when you become a non-smoker. So the proof has to be that you've quit smoking for 12 months. And I do mean quit, not patches, but you've got to quit. Now, some of you might be thinking, well, what if I just said I quit 12 months ago? You can, it's up to you what you put on the application form, but the insurer may ask you to take a test, some sort of screening test that does some assessment as to whether there might be any residual nicotine in your body. But once you've quit for 12 months, then the insurer class you as a non-smoker. So it therefore is appropriate that you review your existing policy. And again, we can advise you about what are the best rates and saving your money. My word, not spending more money on insurance, but actually saving your money and having the same cover that you had before and putting something back in your pocket. So some things to think about there. If any of that resonated with you, again, there'll be a link at the end of this piece to our online diary. Speak to our insurance advisors. There's no charge for that. Have a chat. See if we can either save you money or, more importantly, get the appropriate fit for purpose policy in place. And then you can forget about it for, who knows, till that next review a few years down the line. Just finally, this is the link to our online diary. So if you want to take a quick screenshot of that, or certainly make a note of it, then you can type that link into a browser and that will take you to our online diary. Book a time in to see either our mortgage guy or insurance lady, and like I say, we're happy then to give you a more bespoke response about your situation and circumstances. If you need to ring the office, the number's there, 01756 699 600. And if you just want to check us out as a company and a bit of background, then there's our website address there. Other than that, thank you so much for watching right to the end. Really, really appreciate it. If you enjoy these updates, please subscribe to them. We don't inundate you with any other things. Literally, it is once a month, but it just means you get a little heads up when it's out. And that's much appreciated. And if from time to time we do then issue some other updates, you will be made aware of them, though that is few and far between. I can assure you'll not be inundated with mail shots or videos and updates from us. So other than that, thank you so much for watching to this point, and we'll see you on the next update.